So, this week's outlook. This is what we are looking at out of the whole of G8. So we'll be going over the dollar, pound, euro, Canadian dollar, Australian dollar, New Zealand dollar, yen, and also the Swiss franc throughout this breakdown. Starting off with just an overall summary of the week ahead. It will be an interesting one for sure. We will most likely see a gap off the open in favour of the safe havens. So that being the JPY and Swiss franc. Due to the tariff threats over the weekend, my eyes mainly being on the Swiss franc. Personally, I feel like it's more attractive to long the Swiss franc as of now over the yen, especially with gold continuing to outperform. If you don't know, look into the correlation between gold and the Swiss franc. We're also most likely going to see the euro and pound gap to the downside off the open regarding the 10% tariff on the UK and European allies threat from Trump that we got on over the weekend. So we'll definitely see a spike in the VIX, in my opinion. Just look back to what happened during Liberation Day, April 2nd, April 9th, and you'll get an idea of what this sort of means for markets. Data-wise, this week seems tilted to the more hawkish side of the coin for the UK, stemming from their labour market and inflation releases, which we'll go over. And in contrast, it's more looking on the dovish side for Canada and Japan. So if I actually come over onto the terminal here and get up the calendar for this week, let me highlight the high impact and moderate impact. I've already got my watch list for the main ones, but we'll go through that. So yeah, on Monday we've got Canada's inflation expected to stay relatively firm at 2.2%. However, the month-over-month is expected to drop to minus 0.4%, which obviously is going to come with some dovish repercussions. Tuesday, big day for the UK. We have the labour market data where the unemployment rate is actually forecasted to improve. So yeah, that does fill us with some sense of positivity around the pound for this week, which we'll also go over during the individual currency analysis. Wednesday, we've got inflation at the UK, 10 basis points higher is the forecast, same with core. Thursday, we have Australia's labour market data, which employment change is forecasted to improve. However, the unemployment rate is forecasted to edge up around 10 basis points, as we can see here. We've obviously got GDP quarter over quarter final estimate, which is forecasted to come in 4.3% for the US, which is very nice. Jobless claims as well, so hovering around the 200,000 mark, which we'll go over as well, because they had a great reaction this week to the 189,000 print if you looked at 2-year yields. PCE, obviously cost price pressures. New Zealand's inflation quarter over quarter expected to slow to 0.5%. However, not the end of the world. We'll have to see how yields react. This is quite a big print here coming out of Japan. Core inflation rate year over year is forecasted to drop by 6 basis points to now 2.4%, which is not going to fill the Bank of Japan hawks with that much support, data support on that front. PMI on Friday. We have retail sales in the UK, which is forecasted to stay flat. Same in Canada, and PMI in the US. So yeah, that is essentially this week's main data releases. This is what I'm looking at specifically. So I'm looking at these 6. So yeah. Now, regarding the US. So following last week's US data, we saw yields push a whopping 150 basis points higher, reinforcing the hawkish repricing in the dollar. Obviously, that was driven by this print here. The January unemployment claims came in at 198,000, I believe, and we saw the 2-year yields initially shoot up 86 basis points, which obviously the macro implication of this is markets are pricing reduced probability of near-term cuts and potentially higher for longer policy stance, which obviously is great for the dollar. Not just the labour market, but GDP data and the Fed's beige book signalled optimism in the US economy, helping to support the greenback. As of market close, the VIX is still trading relatively elevated, as well as money markets indicating some degree of uncertainty, specifically around Iran, which should continue to benefit the greenback. Regarding the Fed, last week, the Atlanta Fed doubled the Q4 GDP estimate to 5.4% as the trade deficit plunges. Fed members wise, we have Fed Jefferson and Bostic and others currently believe they are saying that they currently believe policy is well positioned, and with the dot plot showing January's meeting having a rate hold probability of 95%, it creates a hint of hawkishness. So yeah, as you can see here, the meeting on January 28th, 95% hold is what we are at right now. So yeah, that is basically the rundown on the dollar. Statistically, we'll go over this in more depth when we move over to technicals, but statistically, we are definitely in a sort of overbought territory as we're reaching the upper band. Bollinger wise, QQE mod is hovering around the 20 mark. However, I think the data releases this week could see the DXY push to the 100 handle. Pairs wise, I'm looking at GU, EU, and then UJ. Insights. So if we look at what the banks are saying, Corpay, this is more of a longer term. These two are both longer term, so I wouldn't pay as much attention to them now. Lloyds say that they favour the euro and the pound over the greenback for now. So Lloyds are long on euro dollar and GU. Barclays, they say that the current pullback in the dollar, or the upside retracement, is not temporary, and they maintain a constructive outlook on the dollar into mid 2026. So for Q1 to Q2, they're quite bullish on the dollar, which, as of now, I agree with. Bank of America also released this the other day, which is interesting. There's been a golden cross signal, which signals upside potential from January 21st to March 19th, which coincides with this week, which makes sense. Definitely makes sense for us. US retail sales from Morgan Stanley Control Group to cool after October surge despite soft headline. Morgan Stanley expects November retail sales to show a decent headline gain, but underlying momentum to cool as labour income growth slows. So yeah, that is everything on the dollar front. We'll do technicals at the end like we typically do, but looking at the seasonality index, it is evidence that after December, which historically is was a poor month for the dollar this year, January is historically the best month for the dollar. That's due to a bunch of reasons. A lot of them being flow reasons. A lot of money is being redeemed from the funds, going back into the funds. Dollar based, obviously, and other reasons as well. So yeah, seasonality is playing a very big role in the dollar, and obviously January is the best month for the dollar, so it makes sense. Labour market wise, the unemployment rate has dropped from 4.6% back down to 4%. So this line here is the unemployment rate. So yeah, unemployment's fallen from 4.6% to 4.4%, showing an improvement and slight optimism in the US labour market. NFP has gone from 64,000 to 50,000, so not a massive change, nothing to warrant a big repricing dovishly. I mean, if you can see here that the yield reaction from the January's NFP was very positive for the Hawks, and just reinforces the bullish bias on the dollar for this week. So yeah, that's everything on the dollar. Bullish for sure. On the pound, so the pound is a very interesting one because yields are falling. However, this week does seem pretty positive for the UK. I'll go through this. So, to keep a long story short, yields are falling, even with Thursday's GDP print surprising to the upside. The fixed income reaction has been muted and indicates that the move will be faded. Macro data remains weak, with the unemployment rate sitting at a 5-year high. You can see here, unemployment is at 5.1%. We haven't been this high since COVID, I believe. Yeah. Yeah, we haven't been there since COVID. Where was I? And inflationary pressure is falling. So obviously we can see inflation is obviously coasting to the downside as well. I mean, we were at peaks of like 3.8% in August. We're now down to 3.2%. Obviously 60 basis point fall is quite big, especially when the Bank of England's main focus is inflation as of now, which we'll go over. So yeah. This creates a nice backdrop for the Bank of England to continue easing in hopes of supporting this stagnant economy. This will lead to lower yields and rate differentials going against the pound on yield divergent crosses. However, do I believe that this will take place this week? I mean, we've seen GA fall, we've seen GN fall, we've seen GU fall. I think we could get a slight pullback to the upside this week, just based off the data. So yeah, the data this week seems somewhat neutral, with potential to lift the pound if the labour market comes in stronger than expected. Inflation expected to rise also could lead to an initial upside move in the pound as data gets priced in. We are also statistically quite oversold, which could fuel a relief rally. So yeah, if we look, well, as we did look at the data this week, inflation is forecasted to rise by I think 10 basis points. Labour market unemployment rates forecasted to fall by 10 basis points. It's lining up for a solid week. Obviously, one catalyst which could cap pound gains is obviously risk sentiment and the 10% tariff. However, if the market prices in the TACO trade as it typically does, we'll be able to capitalise on this. Insights wise, we have UK, so ING have said that UK data this week risks reinforcing Bank of England caution, supporting the pound, exactly what we went over. Corpay sees the pound recovery in 2026 on yield support and improving fundamentals. Lloyds Bank say the same. You can pause it and have a read of these. And yeah, this was before the UK GDP prints. So yeah, that is essentially it. I mean, looking at the yield reactions, GDP has done nothing really. The December Bank of England meeting had hints of hawkishness, nothing crazy. CPI had a dovish reaction. Labour market last time had a neutral reaction, basically a non-event. So yeah, we're waiting for the next catalyst data-wise, which will be this week. So yeah, I'm neutral on the pound, but I think, as you'll see in the technicals, there are some nice discounted prices we can get into this week, in my opinion. Euro, moving on to Europe. So yeah, from a yield perspective, we are back below the 2.15% handle, indicating that the markets are going to need to see some supportive Eurozone data to totally rule out any more easing from the ECB, which as of now will weigh on the euro from a rate differential standpoint. A lot of the funds are currently increasing their net outflows as well, which indicates further weakness for the euro. With volatility remaining elevated, expect underperformance against safe havens such as the Swiss franc and JPY. So yeah, getting into some Euro Swiss shorts, Euro JPY shorts makes a good bit of sense this week. Obviously, as we've gone over, the trade war is kicking off again, which is never going to be good for Europe as the underdog. Unemployment is hovering around 6.3%, which is not the best. We're in an upwards trajectory. Inflation's pretty stagnant around the 2.1% handle. This alone isn't going to stop any further cuts because 2.1%, 3% is the upper band, and they could definitely cut once more, and it wouldn't really affect inflation. Yield reactions, CPI was essentially a non-event. Same with the December ECB meeting. Yeah. It's a low volatility currency right now, which is why it's being used as a carry. It's being used as a carry trade, which is another reason for euro downside as of late. Looking at the insights, as we've gone over, Danske Bank, this is they're targeting 1.23 on euro dollar, which is obviously quite a big move, and they're forecasting it for a decent time frame, not the next week. Whereas SocGen, Societe Generale, they're saying that short euro yen is more attractive than short dollar yen here. What else do we have here? Lloyds are favouring, yeah, we've gone over that. Pound euro tipped at 1.136 by next year, so this is euro bullish. Essentially what we can gather from these insights is overall, medium to longer term, the insights are bullish on the euro. However, short term, as highlighted by SocGen, they're more bearish on the euro. So yeah, that is everything on the euro front. Looking at the CAD, we're bearish on the CAD this week due to many factors. So risk sentiment for one is going to be decently elevated due to the tariff threats that are being thrown around. We've gone over this. US oil is falling to the downside, limiting loonie upside, not to mention short-end yields falling, following the January labour market data upset with the unemployment rate edging 30 basis points higher. The inflation data this week is also forecasted to push the twos lower, reinforcing CAD downside. Long story short, the macro picture is deteriorating, rates are falling, US oil is minimising export revenue, and risk sentiment being elevated is going to lead to underperformance on safe haven crosses. The only risk is if we see dollar upside, the CAD may follow due to their close relationship. So if you overlay GU and GCAD, you'll see what I mean by the relationship between the CAD and the dollar. It's like whatever the dollar does, typically the CAD follows, which is annoying for a macro-based trader. However, if you time it right and you time the decoupling, it can work. Regarding the labour market, you can see the print in December was 6.5%, print in January 6.8%, a 30 basis point improvement in, a 30 basis point not improvement in the unemployment rate is very big. Especially with the unemployment change falling from 50,000 to 8,000, it's clear that as of now, the labour market is deteriorating for sure. And looking at inflation, we are also falling. We're at 2.8%. We're on a downtrend. It's basically just it's similar to the ECB. Essentially, the market is open for further cuts by the Bank of Canada. You can see yield reactions here. The labour market data was dovish. GDP was minimal. CPI was dovish. The December meeting was rather dovish. So, although we're mildly hawkish here in the longer term, as of now, as of late, as of this week, we are definitely on the more dovish side, which is going to reinforce a downside in the CAD. Corpay have said that they're neutral on the. No, they're not. They're bearish on the CAD. Corpay expects the Canadian dollar to face another unsettled year in 2026. Give it a pause. I give that a read. And then Scotiabank are saying that they are bullish on the CAD against the dollar, which I don't agree with for this week, at least. So yeah, that is everything on the CAD. Now we'll do the Australian dollar and New Zealand dollar as a whole because they're both quite linked to China, which if you haven't watched these before, you'll get the gist of it quite quickly. So yeah, on the Australian dollar and New Zealand dollar, I am actually bullish this week, even with elevated volatility. Regarding the Antipodean currencies, equities are range-bound, which we can expect to see a slight downward move following market open due to elevated risk following Trump's tariff threats on Europe and the UK. However, the Australian dollar and New Zealand dollar are not affected from these tariffs, which could mean we see upside on euro and sterling crosses. So by that I mean euro AUD should fall, GA should fall, especially if equities recover. So yeah, equities are very key when it comes to Australia, or the Australian dollar, I should say. So yeah, if equities are falling, I probably won't get into some Australian upside. However, if they're being range bound, slightly recovering, I'll definitely get into some Australian dollar upside. Regarding China, the Chinese yuan is still strengthening against the dollar, which adds another layer of support for the New Zealand twos. However, data this week points to lower yields for both countries. The unemployment rate is forecasted to edge up 10 basis points in Australia, and GDP is forecasted to grow by 0.5% in New Zealand. So yeah, even looking at the yield reactions in Australia, December's RBA was quite hawkish. December CPI was very hawkish. Labour market data has softened recently, bit of a miss. We saw inflation fall 40 basis points, which is quite a lot to be fair. And then we saw unemployment. The unemployment rate staying sticky at 4.3%, which is good news. And the unemployment change fell into negative territory last month, which obviously caused this dovish repricing and a slight lag in the CAD. However, that was just a lovely opportunity for logs. Just yawned. Looking in the insights, we only have one this week, which is from MUFG, who are saying that they are bullish on the AUD, and MUFG research AUD outperformance this year, and they continue to believe so. So yeah, that is the Australian dollar and New Zealand dollar in one. Looking at the yen now, we are neutral on the yen. I am, at least. The probability of a hike in March is increasing, and with volatility remaining very elevated, safe haven flows should support yen appreciation. However, with the 30-year still rising, it is clear that political and fiscal issues will continue to remain a major headwind for the yen. Directly from Reuters, an article stated that some in the Bank of Japan see scope to raise rates sooner than markets expect. So yeah, there's no saying that the Bank of Japan is not hawkish. They are very hawkish. However, the base rate is still very low, 0.75%. January's decision is a hold. So for this week, I'm pretty neutral to bearish. I think if we can see it here, Bank of Japan watchers see next rate hike by July. That's 5 months away, which is quite a lot. And even though yield reactions are coming in more hawkish, look at the effect it's having on the yen. It's not having a massive effect. all the institutions, medium to long term, you can see every insight here, well, apart from Crédit Agricole, is bullish. If we look at Crédit Agricole's one, actually, it's basically saying the Takaichi trade is going to continue to weigh on the yen. But yeah, regarding the Bank of Japan meetings, yeah, it's probably going to have a slight twang of hawkishness, just mainly due to politics and the weak yen. So the Bank of Japan officials will actually come out more hawkish than maybe they realistically are to try to influence the markets. I mean, Crédit Agricole here have said that investors looking to sell the yen on low liquidity on Monday, but Japan's finance minister warns not to try this because there's a scope for possible FX intervention if investors use the low liquidity on the coming US holiday on Monday to sell the yen. I don't think they will intervene, but yeah, very interesting for sure. That is the yen. Finally, we go over the Swiss franc, which there's not a lot of data on, as it's a very it's not macro driven. Well, it is macro driven. It's not data driven, I should say. So yeah, elevated trade tensions in Europe is going to lead to flows into the Swiss franc. On Friday, we saw a lot of the big funds keep a lot of their positions in the Swiss franc running over the weekend and leading to minimal outflows. This should support the Swiss franc from market open. And with Fed uncertainty, political uncertainty and equities ranging, we should continue to see Swiss franc strength, particularly against its European peers. To be fair, the last SNB meeting was very hawkish, so even from a yield perspective, it does look pretty good, especially with CPI as well, which is very interesting. However, obviously, short-end yields are still in the negative territory, and lows are very low, meaning this is going to have a Swiss franc, as we know, is used as a funding currency. It's used in the carry trade. However, the carry trade performs best when volatility is low, and as you can tell from the risk sentiment gauge here, volatility is not low. Looking at some of the recent news here, gold price surge helps the SNB make 33 billion profit. So yeah, like I mentioned, gold has a very interesting relationship with the Swiss franc. And yeah, that's essentially it for the currencies this week. Now, moving over to the technicals. Now, regarding technicals, this is my watch list at the bottom right here. I'm looking at potential DXY longs, GCAD, GJ, AJ, AUD, NZD, and NZD CAD. So yeah, let's go through each of these. On the DXY, I do think, obviously, the macro thesis is bullish dollar. We all know that. However, statistically, we are very, very oversold, and I think overbought, sorry. And I do think even if we go on the bands on the weekly, we are we're almost at we're above the mean. We're above the mean average. So I do think on the 4 hour a potential retracement. Maybe we won't hit the 98.75. Maybe the 99 handle will be the entry we get. But I think on the lower time frames, if we can get into the bottom band on a key level, I think that'll be good for longs for sure. So I'm looking at, this is a very defensive position around the 98.75. A more aggressive position would be the 99 handle. But I think we can catch a nice bit of a nice play there, especially with what's going on in Europe. So yeah, that is the DXY. That's what I think with the DXY. GCAD, I wanted to catch the shorts up here. Unfortunately, I didn't get into them. However, longs on GCAD makes sense this week, and this does line up pretty well. I feel like if we can gap down here off the open, or even down here off the open, due to the trade tensions, we can then catch a lovely 1-to-1 to move to the upside. So yeah, that's essentially what I'm looking at on GCAD. I'm looking for longs from the 185 handle. This is what I'm looking at. GJ, similar thesis. This is definitely a more risky play due to the safe havens. So I'm not going to guarantee I'll take this if it comes into my entry point. However, this level was clearly being respected. 210 handle. 210 handle there. Alright, 210.75. Yeah. We're looking, I don't want to say over, I don't know, bottom of the band, so some mean reversion would make sense. And the fundamentals this week do make sense. Similar play with the Australian dollar against the yen. Obviously, I'll be monitoring equities for sure. If I make this full screen. And I think an entry here around the 105, if I just mark the 105 handle out, will be very nice. Makes sense fundamentally. I think if the short end and the hawkish BOG really caused a change, we'd have a bigger reaction than just a 0.84% move to the downside. So I think a reaction here for a 1-to-1, a slight pullback would be lovely. That's AUDN. AUDNZD, definitely a more risky play, as obviously we're bullish on both. However, I think this makes sense coming into the mean reversion area. Bottom of the band on the 4 hour and 8 hour. Very nice level, 1.55. If I mark that handle out, you can clearly tell my my statistical and technical thesis here, where I'm looking at key handles, I'm looking at statistical bands, what's happening with mean reversion. Nice levels. So yeah, I think this makes sense on AUDNZD. NZD CAD, I do like upside for sure. However, also we've got the bands tightening. I think this is going to be a lower time frame play on the 1 hour. I want to get in and I want to get out on this. But I do like this. I definitely like this for a reaction. I might even make the stop a bit narrower. But yeah, I believe that's everything I'm looking at this week. Yeah, that is everything I'm looking at this week. Gold wise, I mean, you don't want to be selling at all-time highs. That's just a general rule of thumb, and I think we'll probably gap higher. The best entry point would have been somewhere around the 4,500. Which you would have had to get Friday. I don't think we're going to retrace back down here. I think we're going to move up. Silver, on the other hand, it is in a lovely area. Yeah, I'm going to stay out this week of silver and gold. But these are the main weapons of choice for this week. I'm looking at NZD CAD, AUDNZD, AUDN, GJ, GCAD, DX, the DXY, so EU, and that is it. As always, you can find the terminal I use on cognitoupdates.com. I'll put a link in the bio, and yeah, let's have a good week.